Hi everyone, hope you're all doing well, and today I'm going to do a bit of an education video. So I'm going to show you something that hopefully will help you going forward in the stock market, and I'm going to show you a mistake that I made when I started investing into the stock market. And this mistake was a lot more to do with metrics, and this is probably more focused on growth stocks rather than actual value plays, but you could kind of use it for value plays as well. So yeah, I thought, you know what, a video to finish on at the end of the week, a education video, bring the whiteboard out, and hopefully it's a little bit useful. Now this video, I don't want it to kind of get to the point of views where you go, okay, you can buy any growth stock because it will be okay in the long term. There is still a point of view of valuations, but I want to show you a valuation mistake that I made when I started investing into the stock market. So we'll have a look. So the big mistake I learned, well, how I learned from this mistake, or the stock that kind of made me realize, oh, I messed up there a bit, was Shopify. Shopify has been an amazing stock over the last kind of 5 years, and it was about 5 years ago that I started tracking along with Shopify, and I was going, this company is really good, because it's very much like Square and Tesla. I identified both of them companies as being really good companies for the long term at quite good valuations a while ago. Shopify was a little bit different. I identified that was going to be an amazing business. I was using the business back in 2017, 2018, and I thought this has real legs to go. This could be massive in the next few years. But the big difference between maybe them two and Shopify is Shopify, it had that bit more of a valuation side of it. It was growing absolutely amazing, but I was looking at the valuation and I was getting caught up going, oh, it's a bit of a rich valuation. And through 2018, I looked at it and going, oh, it's overvalued, I can't buy it. Stock went up crazy. 2019, same again, valuation's crazy. Oh, I can't buy this one. Went up again. 2020, eventually I ended up buying it. But I should have done this a long time ago. And I learned from Shopify that sometimes valuation isn't everything. And sometimes you can get caught up with some numbers without pricing in what future a company can have. And I made that mistake with Shopify, and it's a company that I looked at a few years ago. I think I should have bought it, I never did, and I regret that decision. And this is what Wall Street does. I kind of, back in probably 2018, 2019, I started thinking a little bit like Wall Street and kind of not focusing on what am I doing. I'm focusing on the next 2 to 5 years, maybe even longer. Identifying great companies that are going to perform well in the next few years, not in the next 12 months. And with Shopify, I kind of got on the vision of looking at that and looking at a 12-month period rather than, okay, what is Shopify going to be in the next 2 to 5 years? And if I thought through that point of view and started running, okay, what could they potentially do number-wise in the next 2 to 5 years, then you would have started looking at it going, oh, you know what, it's actually probably worth buying. And I made that mistake. Wall Street kind of thinks for like a 12-month period and looks at valuations from a 12-month period of time, whereas I should have looked at this and gone, okay, what's it going to do in the next 2 to 5 years? So just kind of put that into context. What you'll do quite often is you'll kind of look at a lot of metrics. So for example, we are kind of towards, and this is the massive part right now because we're actually coming towards the end of the year in 2020. So let's say 2020, which was last year, we're about to move on to 2021 numbers, which will be completed in Q4 in a couple of months' time. If we look at 2020 right now, what you could see is you could use this for, I'm just going to use this as examples, like a P ratio of 60, you can have a price sales ratio of 60. There's a lot of metrics you could use, but just say, for example, it's a 60, whatever metric you're looking at. I'm going to use price to sales here. So let's say that there's a 60 price to sales ratio on this company. Now, if your company is growing at 100%, now this is an extreme, I'm using this as a bit of a, kind of to make it a bit easier. I mean, it might not be doing this, it might be growing at 50%, 60%, 78, 80%. Let's just say that though there's a company you're looking at buying and it's growing at 100% revenue. Now, if you look at that and you saw that, okay, it's 100% growth and it's going to be at a 60 times sales, you're probably looking that, okay, I'm paying up quite a bit for that. But if that company is growing in at 100% revenue, what's going to happen within 12 months' time is the valuations, because they're done on a trailing basis rather than a forward basis, you would look at the valuation and in 2 months' time, because we've only got really 2 months left of this year, what's going to happen is that valuation or that metric or that price sales ratio will drop down to 30. And you're thinking, oh, it's just halved. Okay, it's not as bad now. And that's in 2 months' time that will happen. And then you're thinking, well, in 2 months' time, okay, it's now 30 price to sales ratio, which isn't too bad. And as well as that, the growth will catch up, and also what happens is quite a lot of companies will beat expectations, so they will even drop even more than what you think. So going back to what we're saying is, like, you could look at a company and go, okay, at the moment its price to sales ratio at 60. What's going to happen in 2 months on a forward basis is it'll drop down to 30. Now what's going to happen in 14 months time, if your company grows 100% again, that metric drops down to 15. So in 14 months time, you go from paying up for a company that was 60 times sales, and then it drops down to 15 times sales. Obviously that's if the share price stays the same. But within 14 months, you have a company that looks incredibly expensive on a price to sales ratio of 60, and in 14 months that could be 15. And then you're like, oh, that changes things quite a bit. And that's what happens. That's the mistake I made with Shopify, is that I looked at the valuation, I did Wall Street, and I looked and think, oh, on a trailing basis it's a 30 times sales, but because it was growing that quick, boom, it was half of that in a couple of months time. And especially towards where we're at now, in 2 months time we're going to be moving on to 2021 numbers, 2022 numbers, and that's where you've got to plan out where it's going to be in the future. And then you look there and you go, okay, in 14 months time it drops down to a 15. If this gets valued back up at 60, that's a massive increase you're going to have. And then it's the longer you think about this is, okay, so if it goes from 15 and it grows at 100% again, it goes down to 7.5, it grows 100% again, it goes down to 3.75. And then you're looking and thinking, wow, that's a massive drop off in valuation. Now, obviously I'm using 100% growth here, which a lot of companies want to be able to achieve over this amount of period of time, but I just kind of wanted to show you how quickly metrics can change when they get updated and when you look further down the line. And that's why, as a company, you or an investor into a stock, you need to look at what could the potential be further down the line, not where it's going to be or what it's done in the last trailing 12 months. You got to start thinking further down the line and start running numbers. And that's the big error that I made with Shopify, is that I didn't work out, okay, it's growing at a huge amount, this is going to happen, that valuation might be rich now, but it's going to catch it up so quickly, and then it's going to be attractive again. And that's what I made the mistake with Shopify. And especially right now, where we're coming up to the end of the year and we're on the trailing 12 months of 2020, soon we're going to be on the trailing 12 months of 2021 and then 2022. So within 14 months, we're going to see a valuation that cuts down very quickly. So yeah, this is one of the mistakes that I made, and a thing with metrics as well. Getting stuck into these metrics and kind of valuing a lot of companies, or even potentially growth companies, off metrics that have been and gone. Whereas you should be identifying, okay, this company is going to be really good in the future, the next 2 to 5 years. Now let me run the numbers and what metrics they will be 12 months down the line, 24 months down the line, and then does it not look too bad? And that's what I should have done with Shopify, and I learned that mistake now. And now when I go into investments, I'm a little bit more, rather than, okay, what's it at right now, we're a little bit more like, okay, what's it going to do in 1 year, 2 year, 3 year, 4 year, 5 year? And that is something that I made the mistake on, and it cost me an opportunity. I've learned from it now, but hopefully me sharing this with you anyway was a little bit useful, and to not make that mistake, I guess, really. So yeah, hope this little education video was useful anyway. If it was, hit the like button, and I'll see you on the next video.